This video will explore diversification and portfolios. We'll discuss appropriate measures of risk for portfolios, and then we'll examine a model called the capital asset pricing model, which is used to explain returns. So what drives the return on a stock? That's what the capital asset pricing model will help explain. As a review to what we did in a previous video, let me show you the graph, the diversification graph. The diversification graph looks like this. I sometimes call it the sliding board graph. And here we have on the y-axis total risk, which is measured by sigma of the portfolio. So we're going to start a portfolio. We start off with 0 stocks. You add 1, 2, and so on. And then you go all the way up to thousands. So I'll just put 3 zeros there of stocks. And when you start getting way out here, you basically are holding the market. And what this sliding board graph is telling you is that as you add more and more stocks randomly, you randomly select the first stock, randomly select the second, and so on, and you keep building a portfolio and you move in this direction, and this direction is the number of stocks in your portfolio, you reduce your total risk. It comes down. But it doesn't go to 0. Your total risk ends up coming down to what's called market risk, and that's measured by sigma m, the variability of the market. While sigma m measures the volatility of the market, in other words risk, I'll show you a better way to measure risk in this video. So you have your portfolio is wiggly from returns, so your returns go up and down over time, and then you have the market return. And so that's what sigmas are representing. Sigmas are representing the sigma p of the portfolio is representing a portfolio, the m for the market. It's just how the returns behave. And the point of this graph is, look, total risk is made up of 2 components. It's made up of this component right here, this height right here, let's say. So if you have 1 stock, you have this much. This is called diversifiable risk. And that is company-specific risk that can be eliminated by randomly picking securities and having a relatively large, in terms of the number of securities, in your portfolio. How many securities? Well, it takes about 40 securities. You still have some, but about 40 randomly selected stocks will get you in this area here where you eliminate most of the company-specific risk. What you're left with is called market risk. From here to here is market risk, or undiversifiable risk that you can't diversify away. Diversifiable risk here, you can diversify that away. So this you can get rid of just by having a portfolio with many securities in it. So now we know that sigma is the appropriate measure of risk when you don't have a diversified portfolio. When you're left of this 40, see this 40 here, and you're left of it, you're not well diversified. You're in this area here. And when you're not well diversified, you have a lot of diversifiable risk that you could eliminate. You still have market risk. Market risk doesn't ever go away. And so when you combine this graph with the fact that your expected portfolio return does not drop as you add more securities to your portfolio, you soon realize that there's no reason to bear diversifiable risk. Why? Because you're taking on this diversifiable risk. In purple here, you're taking that on, but you're not being compensated for it. Your expected return, right, doesn't change as you diversify. So it's not going to change. So you add more and more securities, you come down, but your expected return remains unchanged. And the question is, well, why are you holding all of this extra cost, so to speak? Why are you holding all this extra risk? There's no reason to. And so what this tells you is that the appropriate measure of risk is market risk. And that's where the concept of beta comes in. Beta, little b here as your textbook calls it, but many other authors and financial economists label it beta here as the Greek beta that you would see. I'll try to be consistent and use this little b here, but keep in mind if you look at other sources, you'll often see beta written as this capital B, kind of like italicized, the Greek letter. So what we want to do is we want to explore, well, what is this beta? How does it work? And where does it come from? Beta is everywhere in the financial world. You look up a stock quote and you'll find beta. And so what we want to do is, well, let's interpret it, and then we'll look at an example. We'll look at, for example, Apple stock. So before we go further, let's look at beta and define the beta of the market. Make sure I get a little b here. The beta of the market, I'll call it little bm, is defined to be 1.0. And so that is the beta of the average stock. The average stock has a beta of 1.0, which means there's stocks above it and there's stocks below it. Stocks that have a beta greater than 1. Stocks that have a beta greater than 1 are more risky than the market. They have more systemic, what we call systemic or market risk. Market risk comes from the macro economy. And so if you have the market, if the market goes up 10% and you have a beta, let's say you have a beta of 1.10, then that means the stock is going to go up 11%. And if the market goes down 10%, the stock will go down 11%. I'm simply multiplying the market beta of 1 times the 1.10 to get the 11%. So really what we're saying here is the stock is 10% more volatile than the market when you have a beta of 1.10. Now if you had a beta of 0.70, let's say you have a beta of 0.70, and the market, measured by say the S&P, goes up or down by 10%, that means a stock or a portfolio with a beta of 0.7 will go up or down by 7%. It has 70% of the systemic risk, the market risk. That's what a beta of 0.7 is. So when the stock market goes up 10%, this stock or this portfolio with a beta of 0.7 will go up 7%. When the market goes down 10%, this will go down. This stock or this portfolio will go down 7%. So that's how you interpret it. Interpret it relative to the market, which has a beta of 1. Think of it as the average stock. So before we go any further, let's recap what we just covered a few minutes ago with diversification in portfolios using the sliding board graph. This way we'll know exactly when to use beta and when not to use beta to measure the risk of a stock or a portfolio. So here's the question we're asking: what is the appropriate measure of risk? Let's go through this line by line. If you hold a portfolio of securities that's reasonably well diversified, beta, covered that up, beta, which is a measure of macro or market risk, is the appropriate measure of risk for an individual stock's contribution to the risk of the portfolio and the portfolio itself. Okay, so we want to know the risk of the individual security, we want to know the risk of the portfolio. And under these circumstances where you have a well-diversified portfolio, beta is the appropriate measure of risk. Now, why do we want to know what the contribution of an individual stock's risk is to the portfolio? Well, because we often want to pull a stock out and we plug another one in, we add another security to the portfolio. We want to know how it's going to affect or change the portfolio's risk. So it's important to know each individual security's contribution to the risk of the portfolio. That's what we're trying to get a better handle on. That's important to portfolio managers. Okay, now let's look at the last paragraph here. If you hold a portfolio that's not diversified, in other words, a portfolio of approximately 40 or less securities, or the stocks were not randomly selected, such as a portfolio composed of mostly energy stocks, oil stocks, or banking stocks, something with a concentration of securities. If that's the case, you could have 100 securities in your portfolio, and if they're all banking, you're not diversified. So when you're not diversified, sigma and all its covariances with each of the other stocks' returns in the portfolio are the appropriate measure of risk for an individual stock's contribution to the risk of the portfolio and the portfolio itself. So what it's saying is things get complicated when you want to calculate the standard deviation of a portfolio, because it's a function of the risk of each individual security, and meaning the volatility, but it also has to do with the covariance. How does security I covary with security J? Are they positively correlated? Are they negatively correlated? Do they look like this? Or do they move in sync with each other? So it's not just the volatility of the individual stock by itself contributing to the portfolio. You got to look at all the covariances. That's why this topic is not covered, at least mathematically, it's not covered in this course. You're still going to have to know the concept of, well, when you're not diversified, what's the appropriate measure of risk? Sigma. Now that we've gone this far, let's look at an example of beta. And so here what I did was I went to Yahoo Finance, finance.yahoo. And I went and I pulled a quote for Apple stock. And at the day I pulled this off, Apple stock was $147. And there's a lot of information about the quote. The previous closing price, the opening price, the bid and the ask. Just as an aside, the bid and the ask is basically telling you, look, there's a dealer that's willing to buy and sell these securities, and the dealer sets a bidding price, the bid price, and the bid price here is 147.09. That's the price the dealer wants to buy it at, and he or she will buy up to 1,100 securities, 1,100 shares at 147.09, and is willing to sell, or is asking, a price of 147.10, a 1 cent spread there. And they're willing to sell only 900 shares. So they're willing to buy 1,100 and they're willing to sell 900 at these prices. And that spread of 1 cent is the profit that the dealer makes. Those bid and ask prices change by the second. And so there's a lot of other information here. What we really want to focus in on is the beta. And what's cool about this website is it tells you clearly how the beta is calculated, in the sense that, look, it says 5Y, that means it's looking at returns for 5 years. Well, 5 years, is that one return for 5 years? Well, you're not going to get any way to estimate things that way. You're not going to go too far with one observation. No, it's monthly observations for 5 years. So that's what the monthly stands for. So it's looking at 60 observations, monthly returns, and it's comparing those returns to the market. And the beta of Apple is 1.20. So if the market goes up 10%, Apple will go up 12%. And if the market goes down 10%, Apple will go down 12%. On average, I should add, the relationship every day is not exact, and every minute's not exact. This is an average over 5 years. That's how you interpret it. Apple has 20% more risk than the average stock, or another way to interpret it, it has 20% more risk than the market on average. Now the question becomes like, well, how is that actually calculated? And I'm going to show it to you here. I recalculated it, or came very close, I should say. I came up with a beta of 1.17, pretty close. Here I'm showing you the bottom of the spreadsheet. I actually had 60 periods of returns above, but it all wouldn't fit on the screen. Where I took Apple's closing price, and I took the S&P 500 from a SPY ETF, an exchange traded fund, and here's the prices. Took those prices and calculated returns, because beta and measures of risk are a function of the returns, not the prices. The prices drive returns because returns are a function of prices. But when you actually do your analysis, it's based on returns. And then what I did was I calculated the covariance. How did Apple's stock return behave relative to the market return? How did it behave? And so that's what covariance right here measures. And then I had the variance of the market here. And then I had the beta. I calculated the beta as the covariance divided by the variance. And that's where I got the 1.17. As an aside, I calculated the standard deviation of the market to be about 32%, and the standard deviation of Apple to be nearly 61%. So you can see an individual stock like Apple has substantially more volatility in terms of total risk, and it has more market risk for sure. So that's how it's calculated. If you take investment management, we'll go into this in more detail, but it really didn't take long to pull off these prices, convert them into returns using the formula PT plus 1 minus PT divided by PT. And you can calculate all these returns here. So as I said before, beta is very popular in the real world of finance. It's used a lot, and it's used basically as a measure of risk. Most people have reasonably well diversified portfolios, so it makes sense that they have a measure of market risk. But what we want to do is we want to take it a step further. We want to see, well, how can we use this beta to determine the return of a stock? Because, risk drives the return of a stock. So how does beta drive the return of a stock? And if we understand that, we can better predict and estimate what drives returns on any given stock or a portfolio. So our point here is now to take beta, put it into a model that can be used to calculate required returns, required given the risk of the stock, using beta. So what I want to do is show you this model, the capital asset pricing model, in two formats. One format is the math, and one is a graph, and I'm going to use both, and I'm going to use them interchangeably. But before I get to the graph itself, let me develop the math here. And the math looks like this. It's going to be the math for a line, which we'll graph. But the math is going to look like this. It's going to be required return is going to equal the risk-free rate, say a 3-month treasury bill. Some people use a 10-year treasury bond. Treasury security has no default risk and has no liquidity risk. So it's it's risk-free in a sense. Now there's debate in the world of finance. Should it be the 3-month treasury bill or a 5-year treasury note or a 10-year treasury bond? Well, we're not going to get into that matter. Let's just use a 3-month treasury bill as the rate for the risk-free security return. And then what we need to do is add to this component, this component for the risk-free rate, add a risk dimension. This, by the way, this risk-free rate takes into consideration the opportunity cost of money. So when you buy a stock, you have to take money out of a bank account that earns a certain rate of return, because your required return here is going to have to reflect the opportunity cost. So if interest rates are real high in the economy at a point in time, your required rate of return here is going to be higher because of this risk-free rate's higher. Okay? Right now in today's world, this is a pretty low interest rate. It's about 1%. But the point is, if this risk-free rate is low, the opportunity cost is low, and this required rate of return is low. Let me clean things up for a second here. Now, we need to add a risk component here because the required return is required given the level of risk, and the given level of risk is beta. Beta measures that risk. So here's how we want to put this together. We want to take the return on the market, the required return on the market, RM, subtract out the risk-free rate of return. This right here is called the market risk premium, and it's solely taken on, it solely represents return because of risk. And I'll show you numerically how that works in a little bit. But let's multiply this guy by beta. So we have the beta of the stock, which measures the amount of market or macroeconomic risk that this stock has. And by the way, and I'll put it in red here so it's highlighted, we're going to look at the return for stock I here with the red I. And we have to use the beta for stock I. So that's why I got a red here, beta for stock I. The risk-free rate here, the market return, and the risk-free rate. Those numbers, these variables, apply to all stocks' required return. The only thing that's unique in this formula is we need a beta for a particular stock or a portfolio. So this could be individual stock I, that's what the I's here, the red I's could be individual stock I or portfolio I, for example. So we would need the portfolio's beta or the stock's beta to come up with the required rate of return on the left-hand side. So let's plug some numbers in just to make some sense out of this. And what we want to do is, well, let's price the market first off, meaning let's figure out the required rate of return on the market. And I kind of got to go in circles, but I think it'll help you with the concepts. So here's what we're going to do. I just told you the risk-free rate's 1%. And that means this number is 1%. And we're missing two numbers. We're missing the return on the market and the beta. Let's look at the return on the market. What do you think the required rate of return on the market is? Well, if you go over the past 80 years and you look at history for, large company stocks over a long period of time, it averages 10, 11, 12%. Sometimes it's higher. I often use 12%, so I'm just going to use 12% here. Now, as I've said before in previous videos, I'm kind of driving looking through my rearview mirror. I don't know what the future is going to hold. So I require 12% only because in the past, that's what the market has earned. And so I picked 12%. Now, we know what the beta of the market is. So I'm going to price this thing. In other words, I'm going to use this formula for the market. We know the beta of the market is 1. Okay, we have everything we need. 1 plus 12 minus 1 times 1. That equals 12%. Well, it seems like I'm going in a circle. So what I just said was that the return for the market is estimated to be 12%. Well, that's exactly what I input here. And so this formula is basically saying, look, we can price any stock, any portfolio, including the market. And I just proved it. Put in a beta of 1. I put in these numbers, and I ended up with a 12% return for the market, required return for the market. Now, what if I took the same math, the same formula at least, and I plugged in a beta of 1.2 coming from Apple? So let's do Apple, do it in purple here. Now, the required rate of return is still going to be, for the risk-free rate, is still going to be 1%. The return on the market is still 12, and the return on the risk-free rate is 1%, just like we have here. Same numbers I've used. Look, the same numbers I used to price the market. The only thing that's different is I'm going to use the beta here. Oops. The beta is going to be 1.20. And when I do this, I get 1 plus 13.2%. The required rate of return for Apple stock is 14.2%. So now that's nice, but let's actually graph these relationships. So here we have beta on this axis, and we're going to have required return on this axis. And we know the risk and return relationship has an upward slope, meaning the more risk you take and you move in this direction here, in this direction, you're going to need more required return given the risk. We also know that right here is 0. This is a beta of 0, and we know that T-bill has no risk. It has no co-movement with the stock market because the return is straight and there's no wiggliness. There's going to be no co-movement. So this is going to be the risk-free rate of return. Right here, 0 beta on this axis. And so this equation that we worked out here is going to be graphed. And what it shows you is as beta goes up, the required rate of return goes up. And what we want to do is let's put the market in first. Let's put it in red just put a dash somewhere here and put a 1.0. So somewhere in the middle of this x-axis, put in a 1.0. And the reason for that is, look, that's the average stock. That's the market. And you're going to have some stocks with betas higher, some stocks with betas lower. But the point is, we want to figure out what is the required return on the market graphically. So we're going to come up and we're going to bounce off this line and come over. And that's going to be 12%. And how do we know that? Well, we just calculated it. Not only did we put 12% in here, but we actually came out with 12%. That was the kind of circular logic I was talking about. But it works graphically. And so what we have is, this is 1% right here. And this right here, which I have not explained too much, this right here is your market risk premium, but I haven't explained it in terms of Apple stock, which I'll do in a minute. But the market risk premium is right here. The market risk premium is going to be 12 minus 1 is 11%. What does that measure? Well, that measures, and actually you could measure it right here if you like. Here, that's 11%. What that means is, look, that is the return you get that you're requiring. It's the required return you get for taking on risk only. You also have to tack on opportunity cost of money as part of your requirement. That's 1%. That's right here. And there you have, or you can model it right here as 1%. And then you got your 12% required return for the market right there. This, by the way, this line is called the security market line. And one reason it's called the security market line is because it goes right through the market portfolio. There is the market portfolio. And what do I mean by that? Well, it intersects a 12% required return as we calculated and assumed, and it intersects with this beta of 1. So that is the market portfolio. Now, where is Apple in all this? Well, let's pick a different color. Let's pick blue. And Apple has a beta of 1.2. So here's 1.2. Okay, 20% more market risk with Apple. And so we just plot that 1.2 up. We come up and we come over. And we're going to get that 14.2% required return we just computed. And there's the Apple portfolio. It has a required return of 14.2% right here and a beta of 1.2. It's on the same line with the market portfolio. Now, according to the model, if all stocks are properly priced, each individual stock and all portfolios line up on that security market line, just like I showed you with the market and Apple. So now, what is the risk premium associated with Apple stock? Is 13.2%. And that's composed of the market risk premium times the beta of Apple. So let me show you. Now keep in mind that this 11% goes to all securities, including the market. So Apple gets this 11% market risk premium. And that needs to be multiplied by the amount of market risk that Apple bears. That is the amount of market risk that Apple has. That gives you your 13.2% risk premium for Apple stock. And so we can model that right here. And from here to here is going to be 13.2%. And then the required rate of return on the risk-free here is 1. And that's how we get the sum of these two come up to 14.2%. So now you see that the more macroeconomic and market risk that you take, the more required return you get. And so this is the capital asset pricing model in its basic form. There's more to it. When you take investment management, we'll go further into this graph and better interpret it. Right now we have just required returns, and we'll ask in investment management, well, okay, these are your required returns given the risk. What if you have an expected return that's different than your required return? Ooh, that's an interesting question. And again, we're not going to address that here, but it's a topic in investment management, because what you want to do in investment management is you want to find stocks with really high expected returns, even though the required return that the market's looking for is less. You want to be able to find those, and those would be considered hot stocks. Now, there's an important concept about beta that I have not yet covered, and that is the beta of a portfolio. How's that calculated? It's not hard. The beta of a portfolio is simply a weighted average of the betas of the stocks in the portfolio, where the weights are how much money you have invested in each stock, the percentage of your money invested in each stock, and the weights have to add up to 1 or 100%. So it's going to be the weight in stock 1 times the beta of stock 1 plus the weight of stock 2 times the beta of stock 2 plus the weight of stock 3 times the beta of stock 3, and so on. And you could technically have a portfolio of just one stock. So you'd have a beta of your portfolio, or you could call it beta I, and that would be the weight you put in stock I times the beta of stock I. Well, this would be 1.0, the weight. That's pretty easy. And then you'd find the beta. What if you put all your money in Apple? Well, then you'd have a portfolio of one stock with a beta of 1.2 for your portfolio. So again, the math works even with a one stock portfolio. And by the way, this sometimes hangs people up, and I don't know why, but if you don't put any money in a stock, hey, you don't have any risk associated with it. The weight is 0 and it doesn't contribute to your portfolio. In fact, most stocks don't contribute risk to your portfolio because they're not in your portfolio. So keep that in mind. Now, there's 2 more topics that we want to cover with respect to the capital asset pricing model. The first one is going to be inflation. It's relatively easy to handle. The second one is changes, and that's what I'm going to mean by delta, changes in risk aversion that investors have. And so that's a bit more involved. So let's handle inflation right off the bat here. So we'll start off graphically, and then we'll move to the math pretty quickly. So here's our setup. Here's our security market line. Here's beta. And here we have the market. And when we have inflation, how is that going to affect the security market line? You may not have too much intuition looking at things graphically like I've shown you. So that's where you resort to the math. Remember, the required return equals the risk-free rate plus the market risk premium times beta. So this is, by the way, a very relevant topic right now. Since the coronavirus hit, the Federal Reserve has pumped in trillions of dollars of money into the economy to keep interest rates low and to try to keep the economy moving along without us going into a deep recession. And because of that, people are worried that inflation is going to rear up soon. And the reason for that is, let me just give you the simplest type of analogy. It's not the best, but I think it'll hit home. Let's say you go to bed one night, and overnight the money supply in the economy doubles. Money everywhere that's in existence doubles. Basically what happens is the price of everything doubles. The prices of goods and services double. And the reason for that is you got the same amount of goods and services. You and I are getting up and going to work every day, producing the same amount of goods and services, as we did the day before. The only thing that's changed is the amount of money in the economy. It doubled. So prices end up doubling. It's that type of concept. It's obviously a bit more involved than that, but that's a nice simple analogy. So that's a concern that people have right now, that since the Fed pumped in trillions of dollars of money into the economy, we're going to have an inflation spike. So now, how do you get that into this capital asset pricing model? How do you build that in? Well, looking at the math, it's a bit easier. So if you recall, the risk-free rate that we have here is equal to a real rate plus an inflation premium. And now that inflation premium is going to go up. Let's say inflation goes up, changes by 3%. It goes up 3%. That means the risk-free rate is going to go up 3%. And when that happens, what's going to happen to the security market line? Well, this return right here is going to go up by 3%. The return on the market, the market return also has the 3% built in there. And the 3% is going to be built into the risk-free rate. They actually cancel out because of this minus sign. And what you end up having is the required rate of return increasing by 3%, which is the increase in inflation. And how it's represented is it's represented as a shift, a parallel shift in the security market line. So here's the new security market line 2, we'll call this 1. And now we have a risk where we had a risk-free rate of 1%. Now we have a risk-free rate equal to 4% because everything went up by 3%. It doesn't matter what the risk of it doesn't matter what the beta of the stock, what the market risk is, they all go up by the same amount, by this risk-free rate, 3% and this 3%. That's what the parallel shift is telling you. And if inflation falls a couple of percent, you're going to have a parallel shift down compared to the original security market line. Now that's not so hard. The math in this case is very helpful. Now let's look at changes in risk aversion. With changes in risk aversion, we're going to have a couple of effects that we need to consider here. Let's assume risk aversion increases for all investors. Well, what does that mean? Well, suddenly people are more afraid of risk. It often happens when there's a sudden drop in the stock market or there's an announcement that's very negative for the economy. It can cause fear. And that's what we mean by an increase in risk aversion. And now what investors demand or require is a higher risk premium. Ooh, okay, a higher risk premium. Now, that's where the math comes in and we can try to work with this idea. Let's again look at the math and see, well, where do risk premiums come in? Well, risk premiums come into play right here. This was the market risk premium. Market risk premium. And if you just throw a dash here at 1.0 for the beta of the market, and we come up, and we come over, we get the market return, the required market return, and there's the market right there, that point. That's the risk and return trade-off for the market at that point. Now, if risk aversion goes up, then people are going to want an increase in their risk premium associated with their returns. So that means this risk premium here, the market risk premium is going to go up because people who actually hold the market, remember I gave you examples of people can hold the market through the SPY, the S&P 500, the SPY ETF. Well, what that means is we're going to get a line that shifts like this. And the reason why the slope changes is because we're going to pin things down right here at the risk-free rate. Because when you have no risk, there's no risk premium to change. The risk premium there is none. And so we end up staying anchored at the risk-free rate. And as we move to the right and our beta increases to the right here, as we increase beta, this risk premium is now higher. So you're multiplying all your original betas that you had here by a higher market risk premium. And that means we end up with a steeper slope. The more risk you take now, the even bigger the risk premium you expect. And if investors suddenly have less risk aversion, they suddenly become optimistic and they're not afraid anymore, then the opposite will happen. Let me change colors here to purple. We're still anchored at the risk-free rate, but the security market line slope will flatten out because the market risk premium will have dropped. And you can see that it'll drop right here for the market risk premium. That's what's reflected in this part of the formula. And then since you're multiplying it by all these betas, you're going to get a flatter slope overall. And so that's how you interpret changes in risk aversion. Anchor on the risk-free rate, the market risk premium changes, and that changes the slope. And by the way, I don't think I referred to this previously in the video, but now you know the slope of these lines. The slope of the lines is the market risk premium, RM minus RF. That is the slope to the security market line. Most people think that beta is the slope of the line, but beta is on the axis, so it can't be that. So the reason why you see this market risk premium put off to the left here, to the left of beta, is because it's the slope and not the other way around. A lot of people think that's the slope, but it's not.